Accounting equation and Excel. Purchase and finance equipment. Get ready and some coffee because we're learning the accounting foundation, the accounting equation, using Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our Trust Me, I'm an Accountant product line. Yeah, it's paramount that you let people know that you're an accountant. Because apparently we're among the only ones equipped with the number crunching skills to answer society's current deep, complex, and nuanced questions. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 4 tabs down below: example, month 1, practice, month 2, example, in essence, the answer key, month 1, prior month of operations, practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. Month 2 tab, current month of operations, the tab that we will be working in, of course. Used to have a blank worksheet, but basically we're working in a template at this time. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing, remembering that we're basically building our bookkeeping system based on the accounting equation. The accounting equation, in essence, acting as our trial balance from which we will construct the major financial statements: balance sheet, income statement, statement of equity, noting that that income statement, sometimes called the profit and loss report. So now we're going to record a transaction for the purchase of the equipment. So when we purchase equipment, it's going to force us to do an accrual type of transaction, meaning even if we did pay cash for it, we typically are not going to write it off as equipment expense, but rather put it on the books as an asset. You can see why this was the case why this would be the case if we look at the extreme circumstances of, say, purchasing a $100,000 building that we're going to work out of. If we paid cash even for a $100,000 building, we probably would not write it off as just building expense over here. Naturally, you would say, oh, if you bought a building, it should be an asset, a fixed asset of a building. Why does that naturally occur in our mind? Because we're going to use the building for a long period of time. We didn't consume it in order to generate revenue. That's an accrual type of principle. A similar concept should apply every time we purchase something that we're going to not consume at the point of purchase, but rather use it in the future. So for inventory, for example, that's why we put it on the books as an asset. Don't expense it at cost of goods sold at the point of purchase, because we're going to expense it in the form of cost of goods sold when we use it, consume it, selling the inventory. So now you might say, hey, look, if I'm a sole proprietor, it might be easier for me to just expense the purchase of like property, plant, and equipment. And that might well be the case. But if you're in the United States, you're still most likely going to be forced to put it on the books as an asset, because the tax code is going to force you to put it on the books as an asset, even if you're a sole proprietorship. So that leads us to our next problem. If I put it on the books as an asset, similar to inventory, don't I need a subledger so that I can track the actual physical units? And we basically do need a subledger. However, we have similar situations as with the inventory. Should I do a subledger basically within my accounting system, or possibly should I do it outside of my accounting system? Oftentimes, especially in the United States, we might do the subledger outside of the accounting system, in part because the tax code forces us to follow the tax code for depreciation methods for property, plant, and equipment. Therefore, we will be forced to have a subledger on the tax return typically, or at least in order to create our tax return properly. And therefore, it's and we might as well just use that one instead of having two very complex subledger reports. It would probably be easiest to just use the one subledger, and most tax software can change the subledger between a tax system or a bookkeeping system. So in other words, our choice from the bookkeeping standpoint, if I'm a small business, is do I just want to record my depreciation on a tax basis to make one depreciation for tax and books the same, even though it's not a perfect accrual depreciation system? That would be the easy thing to do, but not the best for financial reporting purposes. Or I can ask my tax preparer to use the tax software and the subledger to calculate not only tax depreciation for taxes, but also a book depreciation, which might be like a straight double declining balance or a straight line method for my bookkeeping system, so that I actually have different depreciation schedules for my books than my taxes. So those are a couple things to keep in mind, remembering, therefore, that I have to talk to my accountant or work with my tax software to see how the depreciation schedules are going to work, so that I can have my general ledgers here match the subsidiary ledger that will most likely be in another software. The other thing we want to keep in mind is to say, okay, if the subsidiary ledger is going to be generated by tax software, I would like to group my property, plant, and equipment accounts and related depreciation accounts and accumulated depreciation accounts in the same groupings that are going to be on the subledger. So in other words, should I call it furniture and equipment, or maybe I should break it out to furniture and fixture, and then furniture and fixture, and then equipment, and then automobiles, and so on. So in other words, we want to talk to the software, the people generating the subledger, so that our general ledger accounts will be in the same grouping as the groupings of the software. So we'll deal with that a little bit more in future presentations. Also, remember that when we buy furniture and equipment, we might buy it from the same store that we buy supplies from. So if I go to the office supply store, for example, I might often buy supplies and just expense the supplies. And that's going to be an easy transaction within QuickBooks oftentimes, because if it's like Office Depot, for example, I might use the bank feeds to say, hey, look, I can see it's Office Depot. The bank feed automatically records a decrease to the cash account with an expense form or check form, the other side going to supplies. I would like to automate that. But if I purchase equipment, then it's going to miscategorize. It's going to automatically expense it as supplies, which is common, which means what's going to happen, we're going to have a large dollar amount in one of the expense accounts, such as supplies. So in order to stop that from happening, if I'm using automatic bank fee transactions to record transactions, cash transactions over a certain dollar amount, you might want to say, do not automatically record that. At least let me see it to see if I should record it as an asset, property, plant, and equipment. So we want to make sure that's the case, that we pick those up somehow. Also, when we look at the furniture and equipment, or the property, plant, and equipment, there's usually going to be fewer transactions in it. We don't buy forklifts all the time. We don't buy buildings all the time. So therefore, it should be easier to manage those transactions because there will be fewer of them in a year time, for example, and hopefully the prior year transactions will be easy to manage as long as we keep everything consistent, because the prior balance, if the prior balance is correct, all we have to do is add the activity in the new balance, meaning increases or decreases to the equipment, making sure that we then provide that information to the tax preparer so they can put it on the subledger. Also, we want to make sure that when we give it to the tax preparer to do the subledger, that we tell them exactly what we purchased. We don't want them putting it on the books as simply generically furniture and fixture or equipment. Why? Because I will not be able to identify the equipment physically in my place that's on the subledger. It will not be a problem when you put it on the subledger. It will be a problem when you try to sell something or dispose of something, and you will no longer be able to recognize the fact of what you sold on the subledger. And that's going to be a problem. Grouping is also a problem. You don't want to put on the subledger 5 forklifts as one forklift, because if you sell one of the 5 forklifts in the future or dispose of it, you'll have to break up the 5 forklifts that you put on the tax return in order to do that. So you want to be careful that you're working with a tax preparer or yourself that knows how to make the subledger properly, and we're communicating between the two people. All right, the other thing with equipment is we might finance the equipment. So that means we might be taking a loan out for the equipment. So if you deal with like construction companies, I've worked with construction companies before, you might have multiple loans, right? It might not be the fact that they take out a loan and then purchase the equipment from that loan, the money from that loan, but every time they purchase equipment, they might take out a loan in order to finance the purchase of the equipment because they want just that one piece of equipment to be the collateral on the loan, right? So that's going to mean, in this case, we're going to have multiple loans on the books. So there's some issues with the loans we want to keep in mind. One is that you might have a short-term portion and a long-term portion of the loan, because if you're paying it back in installments and the loan extends beyond a year, which typically it often would, then you're going to need for financial reporting a short-term and a long-term breakout. However, for a bookkeeping standpoint, I don't want to have a short-term and long-term breakout because that will be logistically difficult when I'm recording my payments, because I'll have to adjust the short-term and long-term portion after each payment, which is not good. So the other thing we could do is have one account for all loans, which are then supported with the subledgers, which are basically amortization tables. But that's also a little not enough detail, because it would be easier for me to have a separate loan per a separate account per loan, so that every time I record a transaction, I can tie out the loan balance to what is on the amortization table. So that is what I would suggest. I would usually put the loans into current liabilities, because some software has an issue with recording things to long-term liabilities, right? So I would put the thing in current liabilities and one account, noting that if there's a long-term portion, which there often would be, of course, I'll do an adjusting entry if needed at the end of the year, breaking out short-term and long-term according to the amortization table. So we'll talk more about that in the adjusting entry process. So keeping all that in mind, the transaction should be fairly straightforward, just increasing the equipment and then taking out the loan, the financing of that equipment. All right, let's go to the month 2 tab and record that thing. This is going to be on 2/28, let's say. So we're going to say we purchase furniture and equipment. Or let's just say we purchase equipment. So I'm going to say purchase equipment, and we're using a loan to finance. So this would be typical. Now, oftentimes there might be a payment and a loan portion, and you might talk to your accountant on how exactly to record it. But I'm going to say we finance the whole thing, in this case, $5,000. So now we possibly have the equipment as collateral on the loan if we default on the loan, right? And so now I'm going to say, all right, well, the equipment's going to go up. Now, the other thing I want to point out here is that we have furniture and equipment here. I think a lot of tax software will usually have furniture and fixture and then equipment as the categories. So in a future presentation, I might look at that more and see how we might break out the categorization. But for right now, I'm going to follow my normal practice, increase in the 5,000 furniture and equipment. Now, I do not have a subledger here for the furniture and equipment. I need to make sure that I have all the detailed information, possibly attaching the invoice to my software, which you can do in like a Xero and a QuickBooks typically, so that when I provide this information to my tax preparer at the end of the year, they see the detail, the increase to the ledger, so they can record that in the software and also identify exactly what the equipment is, so that when they put it on their schedule, we will be able to see from the schedule, ideally, to what is physically, we need to have, it would be like specific identification for the inventory. I need to be able to have like serial numbers, descriptions, so that I can actually identify 5 years later what is on the subledger schedule compared to what is actually in the office, all right? So that's what we want to have there. Now on the loan, I'm going to say that there's another loan that we're going to be taking out. So I'm going to rename this one to loan 1. Notice the practice for the loans. You might have the loan from the institution. So you might call it loan payable from whatever bank that it came from. Or because you might have multiple loans from the same company, you possibly want the last 4 digits of the loan number in your bookkeeping system for the account name. Now, of course, when you combine those accounts to external reporting, we would typically want to combine the loans together and just break them out between short-term and long-term. But for internal bookkeeping and recording purposes, it would be nice to have just one loan per loan, run account per loan, and be able to easily identify it, possibly with the last 4 digits of the loan number, because you might have, the name might not be enough to identify the loan's last 4 digits, because those are usually the unique digits if you have multiple loans from the same institution. All right, I'm going to select the entire column, right click and insert. And then I'm just going to call this, I'm going to copy this one, call this loan payable 2, and for generic purposes, and this is going to be equal to the 5,000. Now we'll talk more about the payments that we'll have to make on that. When we make the payments, we're going to have to break out the interest and principal, as we talked about before with this loan, or decide some other way that we can have adjusting entries at the end of the year, possibly to help us stay more on a cash-based type of system. We might have to actually create the amortization schedule, which you might be able to do yourself, as we looked at before, or possibly ask your CPA or accountant or tax preparer to help you create the amortization schedule. Also realize that if you're on like a cash-based system and you're a bookkeeper, you might just say, hey, look, what I'm going to do is I'm just going to record everything on a cash-based system. And if there was a deposit amount, then you would record the deposit and then just give all that information to the tax preparer at the end of the year. In other words, you might say, look, I'm not even going to try to break out properly the journal entry for the purchase of the equipment. I'm just going to pay for whatever the down payment was, record that as the increase in the loan. In this case, it would be nothing, right? We wouldn't record anything because nothing hit the bank account. But then I would provide this information to the CPA at the end of the year, or the tax preparer, to do an adjusting entry so that they can then take the transaction and record it properly. The reason this might be useful is because the transaction could even be more complex, because you might have like a trade-in or something like that. And if you have a trade-in, then there's a question of how you deal with that for taxes, and what was the book value of the prior piece of property and whatever. So oftentimes when you record it, the CPA, if they're really doing a detailed job, will have to unrecord what you did and record it again according to the depreciation schedule for taxes and so on. So sometimes it's actually easier to just say, hey, look, I'm just going to record everything on a cash-based system. I will record the deposit amount, which you will usually have on the payment for equipment, and then I'm going to record the other side to equipment, and then I'm going to give you all of the purchasing documents I had for the purchases of equipment, which might be attached to the transactions that I put into QuickBooks, which you might be able to give, or zero, which you might be able to give to the CPA firm or the tax preparer, so that they can then pull that documentation up and basically do like adjusting entries at the end of the year to properly record the equipment, properly record any trade-in that happened and removal of the property, and then properly break out the short-term and long-term portion of the loan that's in play. So I just want to point that out. It's possible to do that if everybody's on this, if you have a good CPA firm or accountant that you're working with, and you, on our side, on the bookkeeping side, we're trying to automate everything to make it as automated as possible. I'm not going to try to do, in other words, the more complex transactions. I'm not going to try to do the CPA or end of the year job. I'm going to try to make everything as automated as possible, and then make it so we can easily make adjustments at the end of the year. So just something to keep in mind. But here we're going to put it on the books. We're going to say, here we go, zeros across the board. And so there's that. Let's put some underline here. Underline, home tab, font group, underline. And then we will bring down the balance. And then sum this up equals the sum of the prior balance and the current activity. We're going to copy that, Control C, and go all the way across. I should do whatever. Here we go. Right click and pasted formulas only. All right, this is easy. It's easy peasy. This is easy as sticking a peasy up your nose. That's how easy it is. It's harder to get the pea out of your nose. That takes maybe tweezers. That's the tweezy peasy part. But we're not there yet. We're not talking about that. That's like the adjusting entry process. We'll do that later. Right now we're doing the easy peasy, not the tweezy peasy. All right, so then let's pull down the balances. We'll take these and we'll pull down the balances. Ba-boom, ba-bam. And then let's throw in an underline, home tab, font group, underline. And there we have it.